Something is happening in the gold-silver ratio that most people aren't paying attention to yet. Not because it's hidden, but because it doesn't scream the way markets usually do when they're in trouble. There's no single crash, no dramatic headline flashing across screens, no emergency meeting being announced. Instead, there's a slow, deliberate breakdown in a relationship that has anchored precious metals for decades. And when that relationship breaks, markets don't get a warning. They get consequences. The gold-silver ratio has always been more than a number. It's a signal, a quiet one. It tells you where stress is building, where confidence is shifting, and which side of the market is being forced to adjust. For years, this ratio moved within ranges that traders learned to trust. When it stretched, it snapped back. When it tightened, it relaxed. That consistency created comfort. Comfort creates leverage, and leverage creates fragility. That fragility is now being exposed. What's different this time isn't just that the ratio is moving, it's how it's moving. The pace feels wrong. The reactions feel delayed. The usual corrective behavior isn't showing up when it's supposed to. Gold isn't behaving like the stabilizer it used to be, and silver isn't acting like the subordinate metal it's long been treated as. This isn't excitement, it's imbalance. Markets rely on relationships to function smoothly. Ratios help participants price risk, size positions, and assume continuity. When a ratio collapses, it doesn't just affect the two assets involved. It ripples outward into portfolios, hedges, and expectations that were built on the assumption that the relationship would hold. That assumption is now being tested. What makes this especially dangerous is how quiet it feels. There's no panic yet, no mass repositioning, no visible rush to safety. Most participants are still operating as if this is a temporary distortion, something that will correct itself with time. That belief is powerful. And when it's wrong, it tends to break all at once. Silver has always been the more volatile metal, but volatility alone doesn't explain what's happening now. The ratio isn't just compressing, it's losing its familiar rhythm. Moves that used to trigger rebalancing no longer do. Pullbacks that once relieved pressure now feel shallow and temporary. The market isn't resetting, it's absorbing something. That something is stress. Gold, traditionally seen as the anchor, is no longer anchoring in the way markets expect. Silver, traditionally seen as reactive, is asserting itself in ways that don't fit old models. When both sides stop playing their assigned roles, the ratio stops being a guide and starts becoming a warning. And warnings don't announce themselves loudly. They show up as discomfort, as hesitation, as moments where traders pause and realize the old playbook isn't giving clear answers anymore. This is why markets aren't ready. They're still treating this like a technical event when it's actually structural. They're still debating levels when they should be questioning assumptions. The gold-silver ratio isn't just telling us where prices are going. It's telling us that the framework used to interpret those prices is under strain. Once that realization spreads, behavior changes fast. This is the early stage of that process. The part where everything still looks functional on the surface, but the foundation is quietly shifting underneath. And history shows that when ratios like this collapse, they don't resolve politely. They force repricing not just of metals but of risk itself. This is only the beginning. To understand why this moment matters, you have to understand what the gold-silver ratio really represents beneath the surface. It isn't just a comparison of two prices. It's a measure of confidence. Confidence in stability. Confidence in hierarchy. Confidence that one asset will behave as an anchor while the other absorbs excess pressure. For a long time, that structure worked. Gold was treated as the reference point, steady, defensive, predictable. Silver was treated as the variable, more volatile, more speculative, more sensitive to growth and industrial demand. The ratio translated that relationship into a number that markets trusted. When it widened or tightened, participants knew how to respond. That clarity is now fading. What we're seeing isn't just silver getting stronger or gold getting weaker. We're seeing a breakdown in the assumptions that define how these two metals interact. Silver is no longer responding only to speculative flows. Physical demand, supply constraints, and delivery behavior are playing a larger role. At the same time, gold isn't providing the same stabilizing effect during periods of stress. That combination is dangerous for a ratio-driven market. Ratios work best when both sides behave predictably. When one side starts acting independently, the ratio stops being a tool and starts becoming a source of confusion. That's exactly what's happening now. Traders who rely on historical ranges are finding that those ranges no longer trigger the same reactions. Moves that once signaled opportunity now feel risky. Signals that once felt reliable now feel late. This is where the market begins to hesitate. Hesitation doesn't show up as panic. It shows up as reduced conviction. Positions are sized smaller. Trades are exited earlier. Risk is cut faster. None of that makes headlines, but all of it changes market behavior. Liquidity becomes thinner at key moments. Price moves feel sharper. Corrections don't restore comfort the way they used to. Another important shift is happening quietly in the background. Institutional participants are reassessing how they hedge exposure. Many strategies rely on the gold-silver relationship to offset risk. When that relationship becomes unstable, hedges become less effective. And when hedges stop working as expected, exposure has to be reduced. That reduction feeds back into the market. This is why the ratio's collapse matters more than the absolute price of either metal. It signals that balance is being lost. And when balance disappears, the system has to find a new reference point. That process is never smooth because it forces participants to operate without the comfort of familiar signals. What makes this phase particularly deceptive is that price action alone doesn't tell the full story. On some days, everything looks calm. On others, moves feel exaggerated. Observers looking only at charts struggle to explain why reactions feel inconsistent. The reason is simple: the ratio is no longer providing guidance. And when guidance disappears, markets become reactive. Silver's growing influence in this relationship is especially important. It suggests that physical constraints and real-world demand are starting to outweigh paper assumptions. When that happens, price discovery becomes less about sentiment and more about availability. That shift doesn't happen overnight, but once it begins, it changes how pressure builds and releases. Gold, meanwhile, is being pulled in two directions. It's still treated as a store of value, but it's no longer absorbing stress in isolation. As silver asserts itself, gold loses some of its ability to dictate the relationship. That redistribution of influence is what's driving the ratio lower, and it's why markets feel unprepared. They're still operating under the old hierarchy. The collapse of a ratio like this doesn't mean one asset wins and the other loses. It means the system that governed their interaction is failing. And when systems fail, markets don't adjust gracefully. They adapt through trial, error, and volatility. This is the stage where confidence quietly erodes. Not because something dramatic has happened, but because too many small things are no longer lining up the way they should. The gold-silver ratio is reflecting that erosion in real time. And the longer it persists, the harder it becomes to ignore. As the gold-silver ratio continues to break down, the effects don't stay confined to precious metals. They begin to leak into broader market behavior, because ratios like this sit at the intersection of multiple strategies. When they stop working, the consequences spread quietly but relentlessly. One of the first places this shows up is in positioning. Traders who once used the ratio as a guide now find themselves operating without a clear compass. Long-short strategies become harder to manage. Mean reversion trades lose their edge. What used to feel like disciplined risk management starts to feel like guesswork. And when professionals feel uncertain, they don't double down, they step back. That stepping back changes market depth. Liquidity doesn't vanish, but it becomes selective. Orders that once found easy counterparties now move price more than expected. Spreads widen at inconvenient moments. The market starts reacting faster, not because it's panicking, but because fewer participants are willing to absorb pressure without confirmation. This makes moves feel sudden, even when the underlying cause has been building for weeks. Another subtle shift occurs in how time is treated. Under stable conditions, time works in favor of those willing to wait. Positions can be held, adjusted, and managed gradually. But when the gold-silver ratio stops providing reliable signals, time becomes a risk factor. Participants prefer to act earlier, exit sooner, and avoid being caught in transitions they don't fully understand. This compression of time is critical. It changes the rhythm of the market. Moves that once unfolded slowly now happen in clusters. Reversals feel sharp but incomplete. There's less patience for consolidation. The system is trying to find a new equilibrium, but it hasn't agreed on where that equilibrium should be yet. Institutional behavior during this phase is especially revealing. Large players don't react to headlines, they react to friction. When execution becomes less predictable, they reduce exposure preemptively. When hedges lose efficiency, they simplify portfolios. These adjustments don't grab attention, but they alter flow. An altered flow reshapes price action more effectively than sentiment ever could. Silver's role in this process continues to grow. Its sensitivity to physical demand makes it an early indicator of stress that doesn't show up in gold as quickly. When silver tightens, it sends signals through the ratio that something is changing beneath the surface. Those signals are now being amplified because the market can't easily neutralize them with paper supply. Gold, on the other hand, is caught between its traditional role and a new reality. It still attracts defensive capital, but it no longer dominates the relationship unchallenged. As silver asserts itself, gold's stabilizing influence weakens. That doesn't make gold irrelevant, it makes the relationship more complex. Complexity is the enemy of leverage, and leverage is what kept the ratio orderly for so long. This is why attempts to trade the ratio are becoming more uncomfortable. What once felt mechanical now feels discretionary. Signals require interpretation rather than execution. The shift alone forces many participants to reduce activity. And when participation drops, volatility increases. Another important development is how narratives struggle to keep up. Analysts debate whether silver is overextended or gold is undervalued, but those arguments miss the deeper issue. The problem isn't valuation, it's structure. The system that once aligned valuation, liquidity, and behavior is no longer doing so cleanly. As a result, price moves feel less explainable after the fact. Markets move, commentators search for reasons, and explanations feel incomplete. This disconnect feeds uncertainty. Uncertainty feeds caution, and caution reshapes markets. What we're witnessing now is the transition from a ratio that guided behavior to a ratio that reflects stress. That's a profound change. Once a ratio becomes a warning rather than a tool, it stops stabilizing the system and starts exposing its weaknesses. This is why markets aren't ready. They're still treating the gold-silver ratio as something that will eventually normalize. But normalization requires a return to old assumptions. And those assumptions about supply, demand, and hierarchy are precisely what's being challenged. Until that challenge is resolved, the ratio will continue to behave erratically. And erratic behavior in something this foundational doesn't stay contained for long. As this instability settles in, the most significant shift is not what the gold-silver ratio does next, but how the market expects it to behave. Expectations are the quiet engine behind every trade. They determine how much risk participants are willing to hold, how long they're willing to wait, and how quickly they react when something feels off. When expectations change, market behavior follows, even before prices fully reflect it. Right now, expectations are being reset. For years, traders assumed that extreme moves in the ratio would correct themselves. If silver surged too fast, gold would reassert control. If the ratio compressed too far, mean reversion would restore balance. Those assumptions created a sense of safety. Positions could be held with confidence. Leverage felt manageable. Timing felt forgiving. That sense of forgiveness is disappearing. Liquidity is still present, but it's no longer unconditional. Market makers participate more cautiously. They demand clearer confirmation before committing size. They reduce exposure faster when moves feel unfamiliar. This doesn't cause immediate breakdowns, but it makes price action more sensitive. Smaller trades have a bigger impact. Normal fluctuations feel amplified. Silver's behavior during this phase can appear confusing. Some days it looks calm and controlled. Other days it reacts aggressively to relatively minor inputs. This inconsistency isn't randomness. It's a sign that the market is struggling to agree on fair value under new assumptions. When consensus weakens, volatility becomes the mechanism through which agreement is sought. Another critical change is how participants treat time. Under stable conditions, time is an ally. It allows positions to mature and uncertainty to resolve. Under shifting conditions, time becomes a liability. The longer uncertainty persists, the more uncomfortable positions feel. This leads to earlier exits, quicker hedging, and a general reluctance to commit long-term. This compression of time alters market rhythm. Consolidation periods shorten, breakouts feel more abrupt. Reversals don't provide the relief they once did. The market is constantly reassessing, constantly adjusting, because it no longer trusts its previous reference points. The gold-silver ratio sits at the heart of this adjustment because it connects multiple layers of the market. It influences trading strategies, hedging decisions, and broader sentiment. When it stops behaving predictably, it removes a key stabilizer. Without that stabilizer, every move carries more weight. This is also where the gap between perception and reality widens. Public commentary focuses on daily price action, technical levels, and short-term narratives. Meanwhile, participants closer to execution focus on reliability, consistency, and flow. Those two perspectives don't always align, and during transitions, the execution-focused view tends to dominate outcomes. What's often misunderstood about this phase is that it doesn't signal imminent collapse, it signals transition. The system is learning how to operate under different constraints. That learning process is uneven by nature. Some participants adapt quickly, others cling to old models longer than they should. The resulting mismatch creates volatility. We're now deep in that learning phase. The old rules haven't vanished, but they no longer guarantee results. New rules are forming, but they aren't fully understood yet. The market exists in between, functional but sensitive. History shows that once a market enters this in-between state, resolution doesn't come from a single event. It comes from gradual acceptance. Acceptance that the environment has changed and that strategies built for the past must evolve. And that acceptance is still unfolding. As this process reaches its final stage, the most important thing to recognize is that markets rarely end with a dramatic signal. There is no clear finish line, no announcement declaring that a transition is complete. Instead, change becomes evident through behavior that no longer returns to what people expect. By now, the gold-silver ratio is no longer reacting to short-term inputs the way it once did. The market has already absorbed the initial shock. What remains is adjustment. Participants aren't asking whether something has changed anymore. They're asking how to operate within that change. This is where many get the timing wrong. They wait for a final move that confirms everything. But markets don't offer that kind of clarity. The final phase is quieter than the beginning. Volatility becomes more selective. Moves appear for reasons that aren't immediately obvious. Price action feels heavier, not because confidence is gone, but because risk is being weighed more carefully. Silver's role at this point is no longer about outperforming gold or driving headlines. It's about signaling that physical realities and structural constraints are playing a greater role in pricing behavior. Gold, meanwhile, remains important, but it no longer dictates the relationship on its own. The balance of influence has shifted. What matters most now is understanding that the old framework has been weakened. The ratio that once provided guidance is no longer a reliable anchor. That doesn't mean markets are broken. It means they are evolving. For those expecting a return to familiar patterns, this can be uncomfortable. Strategies that once felt dependable now require adaptation. Signals that once felt clear now demand interpretation. That discomfort is not a failure of the market. It's a sign of transition. The key takeaway from this entire shift is not a prediction or a price target. It's awareness. Awareness that relationships markets depend on can change. Awareness that confidence, once tested, doesn't reset easily. And awareness that structural shifts unfold gradually, not all at once. Those who recognize this early aren't trying to outguess the market. They're trying to understand it. And in periods like this, understanding matters more than speed.